Welcome to my channel. I'm James, and today I'm going through my valuation methods for Levi Strauss & Co., otherwise known as Levi's. What we're going to be doing today is analyzing their financial statements, then using two models to give a fair value of the company using discounted free cash flow models and the Buffett-Graham intrinsic value model. Basically, in short, is this stock a buy or a sell? Before we get into that, what is Levi's? Well, they are an apparel company. It designs, markets, and sells jeans, casual dress pants and tops, shorts, skirts, jackets, footwear, and other related accessories for men, women, and children, and it operates in Americas, Europe, and Asia. The company sells its products through third-party retailers such as department stores and directly to consumers through various formats, including mainline outlet stores, e-commerce sites, and selected shop-in-shops located in department stores. It operates approximately 1,300 brand dedicated stores, and the company was founded in 1853 and is headquartered in San Francisco, California. This is the share price over the last year. It started at around about $21.74. It hit its all-time high at $30.85, but has been on a pretty downward trend since then, settling at $23.10, but with earnings coming up just around the corner on the 26th of Jan 2022. This stock, if we go to its all-time charts here, it IPO'd in 2019, and as said before, it had a pretty downturn during the pandemic and rebounded very strongly to its all-time high, but has had a bit of a sell-off recently. Now we're going to be analyzing the financial statements of the company, and then we're going to be looking at my fair value. So firstly, Levi's has a market cap of $9.2 billion, share price, as I said before, of $23.01, 52-week low of $9.25, and a 52-week high of $30.84. It has a 1.12% dividend, and this ex-dividend date is the 3rd of February, so buy before then if you want the dividend. Firstly, is the PE ratio less than the market? We want to see this is lower than the market average, and the PE ratio of Levi's is 20, and with a market average of 26.59, that is a pass. Next, we want to see is the revenue increasing. The reason for this is because the revenue is the amount that the company brings in from goods or services it sells. We want this to increase as it shows growth, but it is not everything, as we need to compare this with expenses, and we'll be going through that in the next step. But as you can see here, the revenue has gone from 5.5 billion to 5.4 billion. So if we look at the revenue here, you can see in 2018 it was 5.5, went up in 2019, was down in 2020, but has increased before that. So down in 2018, but it is trending in the right direction. Next, what we're going to be doing is looking at the profit, and the profit is the net income or the profit and loss for the company. It's total revenue minus total expenses. We want to see this increasing, and we want this to be positive. And as you can see here, profit has increased 283 million to 457. And if we go back to here again, you can see the profit was up in 2019, down massively in 2020, and rebounded strongly. So even if we take this as an outlier year, you can see that profit has steadily increased. Next, what we want to do is look at the shares outstanding, and we want these to decreasing. What are shares outstanding? They refer to the company's stock held by all shareholders. Companies can then buy back these shares by purchasing them off the market, which reduces the amount of shares outstanding. This makes each share more valuable. For example, if a company has 1 million shares and 2 million in earnings, it has an earnings of $2 a share. If the company then buys back half of those shares, 500,000, it will now have $4 of earnings per share, which has increased it. So what have Levi's been doing? Well, you can see here that Levi shares has gone from 385 million to 397. So that is bad because they are diluting their shares. They are making each share represent a small percentage of the ownership, which makes the shares less valuable. And then in turn, the earnings per share will decrease as earnings are divided by the new larger number of shares. But this can have an advantage if Levi's choose to get the extra capital from this and then reinvest it in the company, and then this has worked successfully, it will gain stock price and then dividend payout. So in the long term, it can be okay, but they need to reinvest this money correctly for this to be the case. Next, we are looking at free cash flow, and you can see I've revealed it there. What is free cash flow? It's the cash the company generates after accounting for all the cash outflows to support the operations and maintain its capital assets. In short, it's cash from operations minus capital expenditures. We want this to be increasing. What they can do with this is they can make capital expenditures or invest in other ways in the existing business. They can pay dividends to shareholders, they can acquire other companies or business units, and they can use this to buy back shares, which seemingly they will not do. But what has it done? It's gone from 260 million to 587. So that is increased massively. And if we just look here, you can see that the operating cash flow has increased dramatically, shot up massively in the trailing 12 months. And you can also see that the capital expenditure has been relatively flat. So it's not that the capex is increasing, it's just that the operating cash flow is. So overall, that is 3 passes and 2 failures. The free cash flow ratio, which is the market cap divided by free cash flow, is 16.06, which is lower than the PE ratio, which is a good sign. And the total dividend they pay is 104 million. And with that free cash flow of 578, it is a very safe dividend. Now we're going to look at the discounted free cash flow and the Buffett-Graham intrinsic value. Here are the current free cash flows, and we've estimated the future free cash flows based on revenue estimates and analyst estimates. This gives a potential value of the company, then we discount it to today. And what does this give us as a value? Well, firstly, you can see that the calculated stock price is $28.47, which means it's trading at a 23% discount, so that is good to see. This is even with the 2022 numbers being below 2021. If we would increase this by a bit and see what would happen then, so let's just increase the numbers here a little bit more bullish again. We'll do 150%. This would actually give a stock price of $46 a share, which is a massive increase. And if we were just a little bit more negative, this would still give it $39 a share. But let's just go back to the original number, which was $28.48. Next, what we're doing is we're looking at the Buffett-Graham intrinsic value. This is earnings per share expected growth. And what this says is that the stock is also undervalued as well, but not massively. It has a fair value of $23.93. So let's have a compare against what analysts are saying. And you can see here that analysts do have it as a strong buy, 3 buying, 0 holding or selling. And the price targets are pretty tight for the entire year. $30 on the lower side, the average is 32, and then on the high side is 35. So analysts are a little bit more bullish on this stock, which is good to see, but analysts tend to be a little bit more bullish because they don't want to miss out. So once again, it has a calculated stock price of $28 a share for discount free cash flow, and the fair value is around about 24. Right guys, thanks for watching. Please give it a like on the video, it really helps me out, and I'll catch you guys next time.